Good afternoon. Good afternoon, everyone. Welcome to another edition of Monday Market Picks. It's Monday, the 17th of March. My name is Thilan Wickramasinghe, the head of research for Maybank Securities here in Singapore. The S&Ps made a bit of a comeback on Friday, and Asian markets are in the green today. The Chinese stocks are making a bullish move northwards. Now, how should we read China's negative inflation reading for February? Our macro team thinks that it's not as big a deal as you think it is. A lot of this is to do with the high base effect, given the fact that the Spring Festival was in February last year. This year it was in January, so that's actually created a bit of a base imbalance. And you do see after the overall festivities, food prices and transport prices coming off. So I think that's mostly what's driving that negative inflation reading. Our GDP expectations, which is about 4.5% for this year, remains intact, and we are expecting to see stimulus coming out of China this year. Now, some of the stimulus is going to spill over to Southeast Asia, and Anand has his latest ASEAN strategy calls for this year, and we'll talk about which markets he has rated as outperform. Then we turn to Jarek, who's going to focus on two Singapore key stocks, Frencken and Singapore SPOST. And then we go across the causeway to speak to Samuel Yin, who says he's turning bullish on Genting. Last but not least, we have two trading ideas from our chart guy as well. But let's first turn to ASEAN strategy. Anand has published a follow-up on his strategy piece from November last year. He's actually kept his upgrade on Singapore, where he said he's overweight on Singapore, and he's keeping that for 2025 as well. He thinks that Singapore's safe haven status and the FTA with the US will give it a bit of a leg up, and the Chinese stimulus will have a positive impact on Singapore. Remember, we've also talked about this in the past. About 2/3 of Singapore's top 50 companies has revenues coming from China. So if China ramps up, a lot of these companies will have revenues ramping up as well. Plus, there's the capital returns theme. A lot of companies in Singapore are returning capital in the form of dividends and share buybacks. And we also think that Singapore will be the first place you will see the mainstreaming of AI. So quite a few tailwinds in the Singapore market. His second overweight is Malaysia. Now, this market has stumbled a bit this year on some tariff fears, as well as some semiconductor concerns that has impacted the big theme that from last year, which was data centers. But he is expecting FDI, foreign direct investment, to ramp up a lot more this year, as well as a lot of the states, particularly Penang, Johor. We talked about the Johor Singapore Special Economic Zone, as well as Sarawak, all having their own development programs, which will add to overall growth for a lot of companies. Plus, there's also a lot of restructuring happening at the monetary and the fiscal level. So a lot of this will drive earnings for Malaysian companies this year as well. So something to watch out for as we go on for the rest of the year. Now, his other final overweight is Indonesia. This is a market where valuations are quite cheap, and sectors like the big banks, healthcare, property, as well as the new economy stocks all have a lot of tailwinds backing them. So there's quite a few things happening in Indonesia as well that is keeping an overweight on this market. In terms of neutrals, the other three ASEAN 6 markets, which is the Philippines, Thailand, as well as Vietnam, we are a little bit more neutral going into this year, and each country has their own headwinds to deal with. Now, in terms of stocks, there's a lot of detail in the report, so please do download our newsletter today, because that's going to be a gateway for you to look at a lot of the key sectors and key stocks to play. But I just want to highlight a few stocks for Singapore, which includes DBS and UOB and SingPost, particularly from a lot of the themes that we have highlighted in the past, as well as some of the new economy names, Grab and C. For Malaysia, some of the key names that our analysts like there are AMMB and Public Bank, as well as YTL Power. And for Indonesia, I mentioned some of the big banks, so Bank Mandiri, BBRI, as well as some of the new economy names like Go2. You can see all the names for each market there up on your screen right now across all the ASEAN 6 markets, but you can get a lot more information if you read the report. Now, with that, I want to turn to Jarek, who is joining us. Jarek, welcome to the show. Now, the semicon space has been stuck for a while. I mean, the news flow coming out from there hasn't been that great, but you've raised Frenken's target price to 134 Sing dollars from 120, and you're reiterating a buy call. What's driving this, Jarek?
Hi, Dylan. I mean, basically, I think if you look at semicon stocks, I think earnings have sort of bottomed last year, but Frencken had a good recovery in earnings last year, and we think that this year, they are also guiding for higher semicon revenue. And we did some channel checks, and we realized that actually ASML is actually hastening its shift of products from Europe to Singapore. So basically, Frencken is actually benefiting from this trend. And if I'm not wrong, I think Frenken's orders from ASML will increase by 30 to 50% this year for the first half of 2025. And we do think that this will, give a good growth in their first half numbers, which will be coming up, pretty soon in the next few months. And we should see semicon revenue, grow year on year, which is quite rare, even in this kind of situation. So that's why we think that, earnings for Frencken will be better than expected. And this will particularly come from the semicon revenue for Frencken.
Right. But one thing is like the semicon sector is still quite kind of struggling, right? And obviously for this stock, one of the overall recovery, one of the catalysts will be the recovery of the semicon sector. So when do you think we can start to get a little bit more excited about that sector?
I think it will be more in the second half, but if you were to wait till then to buy, then you might not be able to bottom fish. So in second half, it will really depend on the ramp up, what the world actually expects. It was delayed from last year to this year. And I think that second half will be the key to look forward to. I think somewhere in May, April, May, we will have orders for 3Q more firmed up, and that will give us a clearer outlook into how second half is. But as of now, even without the second half ramp up, it still looks to be a good year for Frencken. And they are just trading at about 10, 11 times PE. They are the cheapest among the three semicon names in Singapore, UMS and AEM. Yeah.
Okay, so I think that's something that's important. Don't try to time the market too much. Look for good value. Look for good fundamentals, and then buy the stock for that, and then wait for that market catalyst to come in. Now, since I have you on the line, I want to talk about SingPost. I know we talked about it last week as well, but I think the news flow for SingPost seems to be increasing. Now, shareholders have approved their Australian asset sale. Can you take us through that transaction?
Sure. So basically, I think they actually sold to the Australian equity partners for about 900 million Sing dollars. And that is on condition for two conditions. One is that firstly, the SingPost shareholders have to agree, which they just passed through the EGM a few days last week. And then next is they have to get Australian regulatory approval to approve the sale. And that has also been gotten. So basically now all conditions are met. And basically, by the end of the month, the sale should be completed, and the money should have been paid to SingPost by the end of the month. And with that, along with their May results, then there is a very good probability that, I mean, they also announced that they will give special dividends to shareholders, but the amount will only be known in May when they announce their full year results.
Okay, so there's also an announcement that there's freeing up some space in the SingPost Center. Now, I remember you saying that this is another one of the crown jewel assets that they can get, they can restructure and monetize. Can you give us some color on what's happening there?
Sure. So SingPost Center is classified as a non-core asset, which I mean the board and as well the management is key to realize value for shareholders. I mean, basically, if you look at the whole postal network, it is very expensive to maintain, and actually with the declining volumes for mail, they do not need their services to be at Singapore Center because they have another regional logistic hub at Tampines, which is huge. It's about 350,000 square feet in space. And going forward, they have actually plans to consolidate all their operations at the Tampines logistic hub, which will be actually more efficient because currently now the small and mid parcels are done at Singapore Center, and the large parcels are done at the Tampines site. So by mid-2026, they will consolidate all the parcels over on e-commerce site into into the Tampines logistic hub, which will free up about 83,000 square feet of industrial space that they can use to rent, or they do other things with it, depending on the situation. But by the next few years, their plan is to actually shift even the mailing operations and the sorting all back to Tampines Logistic Hub. And with that, they do not need the Singapore Center building anymore. There's about 4,000 of industrial space. Firstly, there's a lot of value in this Singapore Center. Currently, it's valued at 1.1 billion. But if you were to convert, which is close to about 40% of the whole building GFA of industrial space, they could actually convert it to other use. But this is also pending Singapore government's regulatory approval. If they can convert from industrial to, let's say, commercial or retail or office, then you will see a big uplift in valuation for Singapore Center. And even without converting, they could lease out about another 4,000 of industrial space, which works out to be about $9 million annually in terms of rental income. So we do think that, actually there's a huge potential for Singapore Center, and most importantly, this move actually free up their usage of Singapore Center, and they could actually sell the building without any impact to their operations going forward.
Got it. And I mean, one of the key concerns people have is their traditional, postal business. What do you think will happen to that?
I mean, it's a very interesting thought, because if you look at even in the EGM recently, they were very outspoken about this. Basically, management came out to clarify that out of their revenue for mail services, only 20% is using their postal network, which is very high cost to maintain. And because of this 20%, they are losing money. And the government wants to keep this going because of the 20%. Right. So basically now they are in talks with the government to tell them that, hey, this is not sustainable. With digitalization of services going forward, usage will come down more. And if you want me to maintain this postal network and service, then my shareholders are going to suffer, because it's going to be a loss-making situation, right? So if you remember, Singpost basically own Singtel, which is through Temasek. I mean, Temasek through Singtel owns only about 20+% of the company, and 70+% of the rest belongs to other minority shareholders and the public, right? So basically, to get 70+% of the shareholders to subsidize the cost just to maintain the postal network, I don't think is actually fair for these shareholders. So basically, I think they are talking to the government to come up with a business plan. But I won't be surprised if the government also takes it in-house in the near future, like something that we see with SPH Media. Because in the long term, it's no longer sustainable, but it's a service that we have to maintain for Singapore.
Got it. I also noticed that DBS has just announced that they're exercising their call option to acquire Singpost shares as well. Thanks, Jeric. Now
Thanks for having me.
Let's bring Samuel from Malaysia onto the show. Samuel, welcome to the show. Now, Genting has been on a declining trend. It's down about 36% in the past 12 months, and they've had quite a few headwinds, if you may say so. Can you remind us what's gone wrong so far?
Hi, Dylan. Yeah, there were three main reasons for this. First relates to Genting Singapore. It was doing well in the first half of last year, but when the Chinese economy began to weaken, we saw its VIP volumes fall throughout the second half of last year. The second relates to Genting Malaysia. Operations are pretty much close to pre-COVID levels, but margins have disappointed due to higher staff costs, not just in Malaysia, but also in the UK and the US. Now, these two reasons have had an impact on Genting Bhd, but they were not as impactful as the third, which is Resorts World Las Vegas. after it received the complaint from the regulator, the Nevada Gaming Control Board, for admitting illegal bookies, we saw operations tumble. For the fourth quarter, its EBITDA was only $1.5 million US, when the hitherto quarterly run rate was about $50 million US. So that's a major deceleration in earnings. So that sums up what happened to the stock over the last 12 months.
Right. Now, quite a few things gone wrong, but now you're getting a lot more bullish. You're upgrading the stock to a buy. Can you give us where this confidence is coming from?
Right. The Lim family have been buying Genting Bhd shares very aggressively. In the last 2 weeks, they have bought 18 million shares for 56 million ringgit. Now, I can say this, I have been covering this stock since 2008, and I have never seen the Lim family buy Genting Bhd shares so aggressively. To me, there is no greater vote of confidence. And when we come to think of it, it actually makes sense if we consider their valuations. For Genting Bhd, the current price to book of 0.4 times is an all-time low, while the current discount to SOTP per share of about 65% is at an all-time high outside of the COVID-19 pandemic period. To put it another way, Genting Bhd's valuations are so cheap, it basically offers Genting Singapore for free. What we have noticed is that proportionate market cap of Genting Singapore is actually larger than the market cap of Genting Bhd itself, which makes no sense because Genting Bhd itself still owns Genting Malaysia and Genting Plantations, and even if we assign zero value to resource for Las Vegas. And on top of that, there are a couple of catalysts in the horizon. First, 20% owned Tarex, they are expected to receive a reply from the UK Medicines and Healthcare Products Regulatory Agency in April or May on whether their Alzheimer's drug will be approved. If it is, and Tarex is worth 15 billion US as per the guidance, Genting Bhd itself could be worth 5 ringgit and 10 cents per share. And secondly, a positive resolution to the regulator's investigation to Resorts for Las Vegas will likely see the operations recover. Now, what tends to happen is that when the casino is under investigation, they tend to do very poorly because gamblers will avoid going there for fear of arousing any suspicion from the regulators. But when investigations are over, they tend to come back. It doesn't mean that the gamblers are guilty or not. It's just that gamblers tend to avoid any casino which is under investigation, regardless of whether they themselves are guilty or not. So that ought to occur when the investigations are over. In summary, valuations are at or near all-time lows. The Lim family is buying shares aggressively, and there are a couple of catalysts in the horizon. Yeah.
Got it. So deep value, families buying, a lot of the negative seems to be kind of getting resolved. Now that, but since you're already on the line and you said you can buying Genting, you get Genting Singapore for free. Maybe can you give us your 1 minute sort of a pitch on Genting Singapore? How are you feeling about Genting Singapore?
Right. I'm not expecting much from Genting Singapore for the first half of this year. Having said that, I am more bullish for the second half of this year. That is when the new attractions from the RWS 2.0 reinvestment program will open. For example, Minion Land, that has already opened. And also the former Hard Rock Hotel will also reopen. This is extremely important as the extra rooms will house VIPs and premium mass gamblers that have temporarily migrated to Marina Bay Sands. And hopefully by the second half of this year, the impact of the recent Chinese stimulus measures will be felt, and the VIP volumes at Resorts World Sentosa will recover. We have a buy call and $1.01 target price on Genting Singapore.
Got it. So quite a few things to look forward to in the second half for Genting Singapore as well. Samuel, thanks so much for joining us.
Thanks, Dylan. Yeah.
Now let's look at what our chart guy has in store for us. He's got two stock ideas. One is a trading buy on CNMC GOLDMINE. The stock, he says, remains poised to extend its primary uptrend after gapping up with a surge in trading volumes last Friday, forming a bullish flag pattern. You can see a much more detailed write-up in the trading ideas section in our newsletter. And he's also got a trading sell on OILTEK International. The stock's primary uptrend has lost momentum as it struggles to hold above the inverse rounding base pattern, he says. Again, you can have a look at the OILTEK details in the newsletter. In terms of upcoming data, we've got the Nordex numbers coming out on the 18th and the inflation rate for Singapore out on the 24th of March. And then we will also be keeping a close eye on the bank lending rate, which is on the 28th of March, to see whether, especially with all this uncertainty around interest rates, whether we start to see the credit volume side picking up. With that, and we are going to, that's going to be the end of our show today. Thank you so much for joining us, and we'll see you next week, and have a profitable trading week.